Good. Now we are recording. Hello, everyone who is watching this from the record. Thanks for joining. Okay, let me start with the story I wanted to share with you. The story is sort of connected to why this topic, today's topic, the topic of investing and education related to investing in general, is super important, not only to me, but also to us as a company, and why we think it's something absolutely crucial if you want to, create or offer investing or be an investment manager for other people or even manage your own investing. When I was younger, I was that young person who studied finance. I love maths and I loved complicated solutions. I used to think that the best investment product or the most sophisticated investing, something which works the best, even when you are offering investing to other people, is to make it as sophisticated as possible. Have your complicated charts, your complicated calculations, your financial instruments that no one understands. And there is a lot of space to delve into this in finance. There are super complicated financial instruments. There is very complicated statistics, mathematics, even physical principles are being applied to so-called financial engineering, right? So that's what I used to think, that the more sophisticated a product, the more complicated it gets, the better it must be, because it will probably make you richer. And then my mentor, boss here, our chief investment officer in Finax, once told me a story of what convinced him that when you are offering investing or when you are trying to do investing for other people, why this is not the best way to go. He told me about this strategy he designed at his former job, where they were doing a lot of sophisticated and complicated investing. It was a momentum strategy based on statistics, based on a lot of maths, based on more complicated instruments. And the thing was, he thought it worked, and it worked well. It was a sophisticated strategy. It was also very unstable. That means it went down a lot and when it went up a lot. It fluctuated sharply. Its value was volatile, as we would say. That means that it fluctuates sharply up and down. And then once what happened was that a massive decline came. The investments lost 50-60% of their value. That's because of how unstable it was. Now, he knew, because he understood the product, that the strategy would recover and start growing later on. And he was convinced about this. In the end, he was right. It started growing, it recovered, and it made insane returns later on. It was a good strategy because of its sophistication. However, the fact that he was right about understanding the product didn't mean that the clients were eventually successful, because they panicked when they saw the decline, and they withdrew all their money before it started growing again, because they didn't understand the sophistication, the mathematics behind the strategy, and they thought that they must run away. So in the end, although it was a very good investment strategy, it lost all its clients' money because they didn't understand it. And this story, for me, illustrates one simple principle. When you are investing, a less sophisticated product that you understand well is more powerful than a very complicated product that you don't understand. The latter is dangerous. The former is what enables you to, build your wealth properly and invest. That is why I think that education in investing and explaining simple investing that has worked for centuries or for decades, let's say, the financial markets are not that old, is something that will, mitigate the dangers and actually allow you to, invest properly. So sometimes simple solutions that you can understand well are more. And this is a principle that I will try to illustrate to you over this presentation. And I will try to explain to you a simple sort of investing or kind of investing that I hope you can understand well and that I personally use and that I think is the most effective. So based on this story, let's get to it. Before we get to the specific content of how to invest and everything, I would like to, especially for those of you who didn't watch the previous webinar, the previous topic that we covered, I would like to tell you something about myself so that I, at the beginning of the presentation, convince you that I have the necessary knowledge to, to have the audacity to tell you anything about investing and try to be your teacher today. So my name is Simon Pekar. I've worked in Finax for more than 3.5 years now. I have not, decades, but a lot of tangible experience with financial markets. I worked in Finax. What I do here is mostly communication, which is partially this presentation, but it also concerns everything from blogs, podcasts, webinars, everything we use to explain our products and our philosophy and try to help people manage their personal finance and reach out to them. I also work a lot with product. You can see in the right that I am a member of the investment committee. So whenever we compose new portfolios, propose changes or whatever, it usually goes through me. I also try to design the sales strategies afterwards. So I have a lot of tangible experience with how investment products are being created, the calculations, the ideas behind them, and I will try to pass the stories that I've lived in this position to you in this presentation. I also do some project management and corporate finance to also get a grasp of managing money on a firm level. Before that, I worked in the media. I was an editor in Trend, which is a journal that covers, or at least used to cover more in the past, business and economics topics in Slovakia. Before that, I did a lot of economics related competitions even back when I was at the university or high school. When it comes to studying, I studied in Amsterdam, and I also spent a semester in Hong Kong, focusing on economics and finance mostly. Not to only talk about myself, but also about the broader picture of this presentation. As I said last time, but again, to repeat for those who might have missed the previous presentation, this webinar is part of a broader program that we as Finax, a Slovak securities broker-dealer that mostly offers investment solutions, managed portfolios, budgeting tools, and similar things used to manage your personal finance. And what, based on the story that I told you, we believe is that educating people about how products work and how to use them wisely, we think is not only good in terms of doing a good thing for the society, but also so that people can use the products wisely. So we do a lot of education. We produce content in the form of podcasts, articles, media contributions, webinars, and so on. You can find all of that on our social media, on our website, or elsewhere. But we also designed this program that we offer to companies. It is sort of a summary of the most important lessons that we pushed into our content over the almost 7 years now that we are in the Central European market. So this program is composed of 3 webinars. Last time we covered personal finance basics and emergency fund. And after you covered that, it is a good topic to start with because it concerns the steps you can take before even starting to invest. But once you have mastered that, you can move to investing. So today we will talk about how to invest, what you can invest in, all sorts of questions connected to that. The third topic will be specifically tied to one of the most difficult, expensive, and major financial goals people have in their life, and that is securing a decent pension in times when states are becoming more and more unreliable in this question. What you'll learn specifically today as a part of the investing topic is a couple of points. We will start by discussing what you can invest in. What are even financial or investment instruments? In our slang, we call them asset classes, right? So those are types of or basic types of things you can invest in on the most, basic level, the Lego bricks from which you build any type of investment solution. So we will start by discussing that so that you understand the building blocks. After that, we will talk about discussing portfolios. We will talk about stocks and bonds, which are the basic things you can invest in. We will discuss what are bonds used for. Then we'll discuss what are stocks used for and how to invest in them safely. We will discuss several investing styles. So the most probably the 2 most basic investment strategies are active and passive investing. We will discuss the differences between them, and we will discuss why we prefer one of them in Finax and in our philosophy, but we will discuss advantages and disadvantages of both. And then we'll talk about one specific investment instrument that it's no secret that I personally and all of us in Finax think that it is the best investment instrument for any kind of normal person who wants to appreciate their wealth, build some savings, and save up for financial goals. So we will spend a bit more time discussing this specific investment instrument called ETF. And then in the end, there is a Q&A section. As I said, 20 to 15, 20, maybe 25 minutes to discuss anything of your interest. Good. Now that I covered everything that you can expect, let's delve into it. Let's start by drawing a very basic picture of the world of investing, of what are the Lego bricks from which you can build any sort of investment portfolio or what are the basic things you can purchase when you want to invest. The first thing you have probably heard of are stocks. Stocks are just ownership stakes in a company. Each company has issued, let's say, several pieces, maybe thousands, millions sometimes, of stocks, which represent just a stake in a company. It means when you own some stocks that you own a certain percentage of the company. With that come two important rights that you have when you own a stock of Apple, Google, whatever. You have the right to participate in profits. And there are literally laws, especially in the developed nations, that prohibit some sort of discrimination or whatever. Every shareholder has to have some right to participate in the profit that the company makes. So that is the first right you have. The second right you usually have is voting rights. So you have the right to participate in some sort of management of the company. Now, this doesn't mean that you will vote on everything, that you will vote on what employees will be hired or what projects will be undertaken, as usually the management of the company is delegated to separate people from shareholders, because shareholders often own many companies and they cannot focus on day-to-day questions of all of them. So managers often do the day-to-day decisions, but shareholders are often required to vote on the more major things, such as the strategic focus on the company, compensation of managers and similar things. Maybe when they want to acquire another company, often it has to be approved by shareholders. So these are the two rights. When you invest in stocks, you get income from two, or you invest in stocks and you want their value to grow, right? You can get your money, you can get your profit by investing into stocks from two sources. When the company makes profits, in general, it has had a good year, two things can happen. Either it decides to pay out the money that it made to shareholders. This payment is called a dividend. So you can get money directly. Company makes money and distributes it to its owners. This sometimes happens, or especially older, more mature companies pay out regular dividends. What can also happen is that they keep a portion or the full amount of that money. For example, we as Finax are a young company, so we often keep most of the money we manage to make to reinvest it into different projects, right? So to hire more people, to open foreign markets, to develop a new product, whatever you can imagine, right? In this case, shareholders don't get money directly, but the rest of the market can see that the company is doing well, that it has more money than it had before, and that it is now developing new products or getting new clients or getting more employees who are working to, distribute the products to new markets where it hasn't been before. So they can see the company growing and they will be willing to pay more for its stocks, which will usually mean that the stock price will go up. This is called capital gain in finance slang, right? So either the stock price grows because the company is doing well, or it is paying out money directly. That is how you make money on stocks. However, when things are going bad, that means company is losing money and then it goes bankrupt, which can happen a lot of times. Most companies go bankrupt eventually. In these proceedings, owners have a lower priority than creditors. Creditors are people who lent money to the company, so banks who gave it loans, or people who purchased its bonds, which is also a loan, as we'll discuss soon. If this happens, and the company went bankrupt, then the creditors can seize control of the company and decide how to run it, sell off its assets, and get money from that. And whatever is left in the company, and whatever the creditors gain from selling off its wealth or its assets or its buildings or whatever, owners have to wait in line until creditors get their money back, and only then can they get anything. So usually in bankruptcies, they don't get anything. They lose all of their money. So stocks are also riskier, and we'll discuss what that means later on. Second type of basic thing you can invest in are bonds. Bonds are sort of loans packaged into something you can invest in, right? When you purchase a bond, you lend money to the one you purchase it from, especially when the bond is being created or issued, right? So when I, as a government or a company, need some money and want to borrow it, and for some reason I don't want to go to a bank, I can issue a bond and sell it to someone. For selling it, I will get money and I can use that for whatever I need it. But I make a promise in return. I make a promise that whoever holds that bond will be entitled to receiving regular payments from me. We call these payments either interest payments or coupon payments, right? They are fixed and predetermined. You will be receiving them regularly. And then the loan has a certain maturity, just like your mortgage. So you can create the bond for 3 months, but you can also create it for 30 years. And after this period during which you have to pay the interest or coupon payments expires, you return the borrowed amount, we call it the face value, and then the bond ceases to exist. So it's like it functions similarly to a loan. Now, there are two reasons why these bond investments are usually less risky than when you own a company via stock, right? First of all, the payments are predetermined, right? In stocks, you get money if the company makes profits, but no one can tell you what profits any company will make next year, God forbid, in 5 years, right? So you don't really know what payments you'll receive. With bonds, the payments are sort of known, right? You know the amount of the coupon payment that will be paid out. You know the amount that was borrowed that will be repaid at the end. So it's more predictable. But also, if a company goes bankrupt or is not making any profits, then stockholders are usually not getting anything, whereas companies are usually trying to pay their bonds as much as possible, because if they don't, so even if companies are not making profits, they usually try to at least repay their coupon payments, right, or repay their loans. This is because if they don't, creditors, as I said, can seize control of the company. They usually fire the entire management. They usually fire other people. They often sell off anything that the company owns to get their money back, which is not what the managers who want to keep their job and prestige want, right? So they are usually trying to make the payments, otherwise they would be finished. That doesn't mean that bonds are not risky. Companies can still lose so much money and go bankrupt that even those who purchase their bonds will not get any money or will only get a portion back. So this is not to say that when you buy bond, you are guaranteed to get some money over the next 30 years. That is not the case. If there are large bankruptcies, then bondholders also don't have anything, but they are more predictable than stocks. Then the last type of investment are so-called alternative investments. We call them alternative investments because they are made in markets that are different from the well-developed stock and bond markets. So stock and bond markets are the most developed because there is most money in them, and there is also the most regulation and sort of investor protection in them, right? Alternative markets are sort of, there is less money in and also less regulation, rules, transparency usually involved. This is a wide array of investments. These are real estate. So when you purchase an investment property or a real estate investment fund, precious metals, gold, silver, whatever, commodities that can be anything, oil, right? Grain, whatever, agricultural produce that you can also invest in. Cryptocurrencies, a very popular type of investment in the last days. So a really wide spectrum of investable assets. The income is from various sources. Its price can grow. You can have rental income if you are investing in real estate and similar things. Okay, I know that was a lot of information, but these are the Lego bricks, right? What you usually do when you invest is you take many stocks, you take bonds, you maybe take alternative investments, and you combine them. You build a Lego building, which we call a portfolio in investing, right? So let's now talk a bit more about how to do that. The first thing you should know when trying to think about how to mix up your portfolio or put the Lego bricks together is a relationship between risk and return, right? So what does that even mean, right? Because those are not self-evident words. Return is how much you are roughly expected to get, right? It's the potential of earnings that you can get, often based on decades of historical data, or even the nature, right? So that is the return, how much you can earn or are expected to earn. Risk is the price you will pay for that return, right? So risk is usually measured by how unstable the investment is, right? So when something is risky, that means that the value of the investment will fluctuate up and down more sharply. If the economy is struggling and investment or the company or the government is struggling and the investment goes into decline, if something is riskier, it tends to go deeper, right? The falls in that investment tend to be deeper, right? So if something is riskier, there is a significant chance that in 5 years' time, let's say, you might be in a significant profit, but also in a significant decline, right? And if investments are riskier, you might then need to be more patient and give them much more time to work, right? There is a simple relationship usually in finance that whatever has a higher return potential, when you can earn more, the investment is usually more riskier. So it will be more unstable, go into deeper declines, fluctuate more sharply, both upwards and downwards. And usually the least risky assets earn less than, right? You can see in the chart that, the least risky, but also investments that don't earn much are cash and bonds, because you know that on cash, who has a savings account knows that it's still very hard to earn anything on it. And even when you have a term deposit in a bank, there is some interest, but it's not, it won't make you rich itself, right? Then as you move to other types of investments, such as real estate, stocks, or alternative investment, you have higher risk, but you also have much higher return potential than by holding only cash and bonds. And now, why am I telling you this, or why you can see the defensive assets, the bonds and cash that don't earn much but aren't very risky? The reason it is highlighted is that in Europe and also in Slovakia, but this is not just the problem of Slovakia, this is a problem of Europe in general, we tend to limit ourselves throughout our lives for any sort of financial goal or savings. We tend to limit ourselves to cash and bonds, right? Most people just hold their money in a bank, right, in the form of cash or in some time deposits. And even if they invest, people or financial advisors in banks usually don't explain to them how riskier investing works and what risk even means. So they just tell, if you want a safe option, invest in bonds. So people usually automatically invest in bonds, and then then that's all they hold. We think that is not a good thing, and it's a pity that no one tries to educate people about the riskier options, because you can handle them wisely if you understand what you are doing, right? And if you hold any sort of money in defensive assets throughout your life, then you usually won't make any money, and inflation will just erode it, and it will be very difficult to build any significant wealth and save up for some major purchases or for retirement, right? So it's good to explore the world of investing in depth and also look at risky options, and we'll do that today. However, before that, let me spend a bit of time talking about cash and bonds as well, because there is potential to handle them, unwisely, even in this territory, right? So the first thing I would like to talk about is the cash, right? And investing in cash. You might have heard or probably noticed that if you have mortgages or loans, that interest rates are now much higher than they used to be because there was inflation. Central banks increased interest rates to fight it, to try to fight inflation. And that meant that a lot of loans became much more expensive than they used to be. It's normal to be paying more than 4% for a mortgage nowadays, right? So you probably know that. However, what is also sad is that many banks didn't respond by being equally generous when it comes to savings accounts or current accounts or even time deposits, right? The deposit rate of the European Central Bank is now 3.5%. It used to be even higher, but they lowered the interest rates just last week. But it's now 3.5%. I don't think any one of you is making 3.5% on their savings account or even on a 1-year time deposit or something like that, right? There might be 1-2%, but not as high, right? This is because people sort of got used to low rates and not earning anything on cash and aren't being very pushy about it, so they can get away with not increasing it sufficiently, right? That doesn't mean that you can't get these interest rates. There are now so-called money market investment solutions. Money market refers to these sort of cash-like investments, right, that usually try to replicate the central bank interest rates. There are ETFs that copy central bank interest rates. There are good mutual funds that earn returns nearing 3%. Even we in Finax, but I'm not here to sell products, have a money market solution that sort of functions like a savings account from which you can withdraw money within a week. So these solutions often offer higher returns than the zero you will get on your savings account, while keeping you the flexibility to deposit and withdraw funds, right? So it's good to explore these solutions, especially if you have a more significant emergency fund, let's say, and it is sitting in a savings account without any interest rate, right? So even with cash, there are good solutions now that are better than the nothing you will get in a bank, right? That was cash. Now let's spend a bit of time talking about bonds. When I said that many people invest in bonds and that's a pity, that doesn't mean that bonds are not a good investment and they don't have a role when you are managing your money. What you have to be careful about is to use them for the goals they should be used for, right? So who should invest in bonds? What are they good for? As I said, bonds are less risky than stocks. That is because they have predetermined payments and because they have a higher priority when the company or the government is not doing well, right? So they should be used by people who don't want much risk, right? That can either be cautious investors who just don't want the value of their portfolio to fluctuate too much up and down and don't want the chance of significant declines that would, erase one third or one half of the portfolio when you would have to wait until the investment recovers. That can be because you dislike risk and you just want, to earn less, but to the portfolio to be more stable. Or, and that is connected to the second point, you cannot afford to give the investment much time, right? In investing, time is usually the best cure for risk. And I will show you a lot of data for that later on. But so sometimes when you invest, for example, in the stock markets, the best thing you can do when the investment declines is just give it a couple more years to recover, right? Because stock investments, especially if they are done into thousands of companies, they usually do recover over the long run. Sometimes you cannot afford to wait because you have money dedicated for some specific goal that has to be done in, let's say, 5, 7, or 3 years, right? Maybe you want to send your kids to a university in 5 years, or maybe you want to purchase a house down the line and you don't want to wait too long for that, right? So if you have a limited time horizon, it's good to include some bonds in the portfolio. Usually it's good to mix them with stocks. So for any financial goals that are roughly 3 to 10 years away, it's generally advisable. It's a rule of thumb, but it works pretty well for us. So we usually tell people that if your goal is 3 to 10 years away, you should mix stocks and bonds in your portfolio. The specific mixture, you don't have to worry about it. There are nowadays robo-advisors, such as our company, but we have a lot of competitors, where you just, fill in a simple questionnaire about your attitude to risk, about your investment goal, about how much you would like to make, save, about when you need to withdraw the money, and it will automatically recommend a mix of stocks and bonds that is suitable for you. I think that is the best solution for people who just don't want to do all the calculations and projections themselves in an Excel, which wouldn't be advisable if you haven't studied finance or something like that. And then also, in general, bonds not only increase your chance of being in a profit after a shorter period after a shorter time period, but they also lower the instability of the investment, right? When you have stocks, it fluctuates up and down very sharply. When you have bonds, it fluctuates up and down less sharply, right? So if you want to mitigate the instability of your portfolio and mitigate its declines, then it's usually good to have bonds there. So it's sort of like an insurance. The reason why is that I included the word correlation there, right? This just means that usually when stocks decline, bonds tend to either grow because everyone flees to them. They are called a safe haven asset in finance. That means that usually when stocks decline, bonds tend to grow or increase. But even if they don't increase at the same time when stocks are decreasing, they at least tend to fall less, right? So they can serve as sort of an insurance against declines in the portfolio. That was about cash and bonds. Now let's talk about the thing that is usually completely underutilized when it comes to European investing, and that is stocks, right? The reason why I will talk about them or why we think they are great is that they are one of the most consistent assets in beating inflation in our history, for the history for which we could accumulate financial data. You can see that this is the period 1926 to 2020. There are a couple of important remarks to make here. First of all, this is not stocks of any particular company. This number of beating inflation doesn't mean that someone analyzed their charts and looked at financial statements and listened to CEOs speaking in the media and selected Nvidia or ExxonMobil or whatever else and beat inflation. This graph simply depicts an investment into the stock market, right? What do we mean by investment into the stock market is sort of buying all the significant companies that you can buy out there. You usually do that by purchasing an ETF or a similar instrument that allows you to buy hundreds or even thousands of companies that represent most of the market value out there. So it's a large group of companies. It's stocks as a class, right? Together, most of them taken together. And then you just have this market and you benefit from market value increasing. And if you hold this investment, you can see that for the period 1926 to 2020, it managed to beat inflation by a wide margin, much more significant than other asset classes such as real estate or cash or bonds included there. And that was in time when you could earn a lot of interest on cash. That wasn't the case for most of the last decade, right? So when you take stocks and a large group of them, they beat inflation. And this has been relatively stable, right? For example, this chart shows, it's not the global market, but it shows a large group of large companies headquartered in the United States. In investing, this is represented by a stock index. Stock index is a sample of a market, usually representing or used to measure the value of the market, right? So this is represented by the index S&P 500. You might have heard of it because it's relatively popular in the media, right? It's often a proxy for how well the US market is doing. But you have similar indexes for Europe or for emerging markets and similar things. So this is for large US companies. The reason we are using it is that this is the only index for which we have 200 years of data, as you can see in the chart below. For other regions, it's much harder to go that much in the past because we didn't have much financial data tracking, right? But you can see this is a logarithmic scale. Don't worry about it. The bottom line of this chart is that the growth has been relatively stable over the 200 years. Although there are some declines, as you can see, sometimes even for 5 or even 10 years. So the declines can last for long. There has been a stable growth. Why is this? Why does the value of stock market tend to grow over the long run? There is a very simple explanation to this. As I said, stocks as a large group usually reflect the profitability of companies. When companies make high profits, the value of stocks increases, right? And the fact has been that the profitability of humanity, right, of the entire market, has been growing over the history. And it always usually does. Why is this? Because we make technological advancements, for example, that allow us to produce things more efficiently. That is, spend less money for producing the same amount of output or products or something like that, right? Automating things. So any kind of invention from the wheel to ChatGPT increased the profitability of companies because it allowed us to produce more efficiently, right? So things such as technological inventions always increase the profitability of companies over some period, right? The same access to education. Today, many more people have access to at least high school education and even university education than in the past. And in the developing world, their number is still expanding, right? So the more people that get access to education and can do jobs that are more productive and that create more also increases the profitability of the market as a whole. So it is these factors that ensure the success of investments in stocks in general, right? It is the mechanism that drives the growth of the global economy and drives the global growth of markets in the long run. And it is the reason why this graph here has looked like this over 200 years, because humanity is always trying to strive forward and, invent new things and create more and have more. That is, this sort of curiosity is a good feature of humanity that has been relatively consistent, right? However, not to be overly optimistic. If it was this easy, everyone would do it, right? There is a price you have to pay for this 200-year growth, right? And that is the instability I was talking about, right? So here, what this graph shows is declines of the same index, right? It's the same group of stocks as here, right? Large US companies. What the chart depicts is how deep it can decline from the previous maximum, right? So when that blue line goes up back to zero, that means that the decline has been recovered and the stock market again is growing beyond its previous highs, right? And when it's down below zero, that means that it's at a decline relative to the previous maximum, right? So that is it's sort of the price you can pay for it, right? You can see that at many times these declines exceed 10, 15, 20, or even reach 30%, right? So it is not only perfectly possible, it will happen if you invest throughout your entire life, that at some point you will see 1/5 of your investment account just disappear over a couple of months because the economy is struggling and the stocks are falling, right? So that is a thing you should count with. What you can also see in this graph is that no decline has been there forever, right? All of them have been recovered. You can see that the blue line always eventually, after some years, goes up back to zero. That means that the market has recovered from the decline and continues growing upwards, as you can see here, right? But you have to count. Then there's, in the bottom right, there's a quotation by Charlie Munger. It's he died recently. You might better know his partner, Warren Buffett. So together they've built one of the most successful investing companies in history, and they become, members of the richest people on this planet. And he himself says there that, when you invest for a century, you will see declines of 50% 2 or 3 times. So that is to say that when the markets are declining, that is not something you should panic about, thinking that is unnatural. That is something you should actually count with and expect before you even start investing. You should, be completely ready that you will live through this. And it is easier said than done, to be fair, because, investing is often a psychological game. Let me tell you another story, right? When I started investing, to be fair, it's not too much in the past. I think some of you might have been investing for longer than I did. But when I came to the market, at first there was a lot of growth. It was, COVID times. People were investing. People were trying to learn about stocks, and people, oftentimes had no better things to spend money on, right? So during COVID, actually, stock markets were growing pretty rapidly. So it seemed easy, right? It seemed easy at first. It seemed that everything is going as planned and that we are going to get rich soon. And then, the war in Ukraine came and inflation came and interest rates got higher and everything, the period a year, 2 years, 2.5 years ago wasn't very good for the global economy. And markets started to decline, right? And the decline, it wasn't very long, but it lasted 2 years before the markets recovered. So me, all of my friends saw red numbers in their accounts for 2 years. At first, you are sort of determined to live through this. You know that this is natural. But the longer this occurs, the longer you have to watch the red numbers, the longer you have to, wait for the markets to recover, but they don't and fall back. The longer you start doubt whether the data are true, right? You start thinking, what if this time is different? What if this time we are braced for 20 years of a decline, something that's never happened? And oftentimes, financial media try to feed into this because, when you are a medium that sells ads, you want the most clicks, and you can get the most clicks by exaggerating things, but by creating unnecessary panic, by creating fear, because that is what people click on. So when you read them, then you might even get yourself more panicked than thinking that there is going to be 20 years of red numbers and that you should sell it off to avoid it and maybe look for a different type of investment, right? And usually that's the worst thing that can happen, because if you sell, you can see that then you miss the recovery. That you see a lot of recoveries in this chart, right? So whenever that happens, first of all, be prepared for it. And second of all, yeah, live through these psychological doubts. Because for me, it was even, many of my friends started investing based on my advice and everything. And that was even worse because they were texting me and calling me, this time is different. You lied to us. You lost money to us. And then I really started, doubting my strategy even more. So whenever this happens, it's primarily a psychological game. It's not that much about watching your charts or computing Excel tables. This illustrates a very, very similar principle, right? So I think when you combine these charts, this growth and these declines that then recover after a couple of years, the best strategy, according to us, for common people, is to just buy regularly, set up a standing order, and then forget about your investment for many, many years, and then check it later on, and you will be positively surprised, right? Don't check it too often. The reason is that declines would only make you nervous, and you don't want to let them. You don't want them. You don't want to let them do this to you, right? Why? Look at this chart. The red dots are the maximum percentage decline into which S&P 500, again, the market, the US market, for which we have a lot of data, declined over in that specific year, right? That's in each year. You can see that it declines in every year. Declines just happen. That is something that will 100% happen in the next couple of months, right? Many times reaching 10, 20%. That's a lot of money, especially if you've been saving for quite some time. It's a lot of hard-earned money. Sometimes reaching 40 or even you can see 50%. So it is completely possible that is not as common as 10 to 20% declines, but it is possible that if you invest for a lifetime, even 50%, half of your wealth, that's a lot, will happen. Despite the fact that declines occur all the time, you can see that the blue bar, and that is the final return in that year. It is the final profit with which the investment has ended that year. You can see that the blue bars are positive in most of the years. So it's completely normal for a 15% decline to happen in a year, and the year ending with a significant profit. The markets just, fluctuate. That's what I said, up and down. So the fact that declines happen doesn't mean that most of the years will end up in a profit. And some of them will end up with a loss. But in the long run, it usually grows because of technological advancement, because of educational advancements, as I said. What you have to do is to hold it for a long enough period of time. And if after some period of time you're at a loss, you have to give it more years, right? You have to be flexible and patient, right? So the best thing is just not even to look at the declines, just forget about it. How long do we need to ensure we are safe? How long should we invest to reap these benefits? No one can answer that for sure because past data doesn't mean that the future will behave exactly in the same way, but there are indications based on the past, right? So is 10 years enough? It's a lot of time, but as I said, sometimes 10 years is not enough, and you can see it here. These are decade performances. However, one very, very important point, inflation is already subtracted from these numbers, right? So if you earned 1%, but inflation was 2% on average per year, right? You are at a loss because prices have grown faster than your investment, even if you have made slight profit, right? So we already adjust this for inflation because we don't want prices to get ahead of us, right? We want to be faster than inflation when saving up and building wealth, right? So you can see that some decades were super lucky. This is also another technical point. The numbers are not for the entire 10-year period, but they are on average per 1 year of that decade, right? That means that if you make 16%, it's as if you made 16% in each of the 10 years, sort of 10 times 16% in a row, right? So that's a lot in total. That's more than doubling your investment over the decade. So just beware of that so that it doesn't seem unnecessarily low, right? You can see that some decades are super lucky. Some are unlucky. You can even end up at a loss at some of them. Not very common, but you can. So even when investing for 10 years, that's usually not enough. That's why we said that for periods of 3 to 10 years, include bonds in your portfolios to make it safer, right? So we need to extend this. Let's look at 2 decades. Let's invest for 20 years, right? From 1900 until 2000. You can see that 20-year periods already have a higher success rate. The thing you have probably noticed is that there is no loss there. So even after subtracting inflation, when you invest for 20 years, you make money. You exceed inflation, you appreciate your wealth in real terms, right? So your savings don't get eroded, right? But even these periods, some of them are pretty lucky. Some of them have positive returns and exceeded inflation, but aren't necessarily, the numbers aren't super high. But, 2 to 4% above inflation is still pretty good, right? Let's extend it to 30-year periods. Let's look at this, truly lifelong investing. Now we can see that it is pretty stable, to be fair, right? You can see that it's 5 to 7% per year. And as I said, that's 30 years of 5 to 7% in a row. So that's an insane return in total. And you can see that there is just no period when you wouldn't have made this pretty significant return if you invested for 3 decades in, the past. Now, an important disclaimer, and that's just not for legal reasons, but because it's true. Future can behave differently. It's not guaranteed that the markets will always behave as in the past, right? So it's not the point to tell you that if you invest exactly for 17.5 years, you have zero risk of being at a loss or something like that. That is not what I wanted to say. What I wanted to say is that the proper type of investing is to have it truly lifelong. Throughout your life, save a portion of your income and invest in it in stocks. And do that for 15, 20, 25 years, right? Then you are very unlikely not to profit and appreciate your wealth very significantly. Because if you invest for a generation, right? 25 years is enough for generations to change. The world will change to a, much more productive place, many more inventions and so on. Just make a simple exercise again, right? Draw this picture. Imagine the world 30 years ago in 1994. I will help you imagine it. That is before Google was founded. It's before Facebook was founded, and it's before the first iPhone was introduced. The first iPhone was even introduced more than 14 years after that point, right? So it's still way before the first smartphones. So 30 years ago, none of these things existed. Can you imagine today's world without social media, without smartphones, without internet and internet browsing that is, easy, without gaming computers, without AI already sort of? Probably not, right? So the world changes a lot. A lot of technological innovations and advancements are made over a generation. And a lot of money is made on that, right? You know that these companies that invented it are now multi-billion dollar companies, right? The biggest, or even trillion, and some of them, some of those I named, right? So a lot of money is made on this progress, and holding the stock market, right? Holding the portion of stocks of the largest companies in the world enables you to participate on this progress, to sort of reap a portion of this profit, right? And that is really what is the idea behind proper investing. But you have to do it for a generation so that all these advancements actually happen, right? And survive any bad things that happen in the meantime. And there will be a lot of it, right? So that is the idea. Couple more words on this, optimism, pessimism, short-term panic and everything. You might be tempted to think that when there are bad news out there, the economy or the markets are poised to, decrease. The reason why you should never react to negative news is that this information about negative news is usually already incorporated in market prices. What does that mean? The prices of stocks are often not really influenced by common people like you and me, although if masses buy and sell things, they can move the prices. But they are often influenced and set by huge investors. I'm talking about hedge funds with billions under management. I'm talking about banks and their mutual funds. I'm talking about, these sophisticated investors. These guys always get to information much faster than us who are here, right? Me from my living room, I will never know anything faster than a hedge fund with supercomputers and analysts from Stanford, right? I will never learn anything that they don't know yet, right? So whenever there is some sort of negative news out there, the stocks have already declined, or these people have computed that it's not really that bad, right? Or have information that we don't have yet that suggests that it is not that bad yet, right? So whenever you are reacting to negative news, you are entering an already lost fight. You are selling, although the price is already fairly low to reflect that news, right? So it's not that you avoid a future decline that will come because of that negative news, right? Any future decline will come because of some new news, right? Some new information that we don't know yet, and that information might very well be positive, and we miss out on growth, right? This means that oftentimes, despite many negative news happening, the markets just keep growing and don't react to them. This chart shows negative news. All those points, all those little titles are some negative news, some of them sounding pretty bad, right? Yet, It's since 2009 until 2021, a lot of years. Yet most years markets just keep growing. They don't care about negative news, right? Why? Because companies can weather a lot of negative news and humans are creative. And although this might not seem like it when we watch politicians in the TV, many people are good crisis managers and we can adapt as as a species, right? So it's never good to think that just because there is a huge negative title in the media saying that something bad happened, that you should sell your investment and wait until bad times are over. Because there are also, you know, for many people, bad times are always. I've been involved in investing for a long enough period to know that there is always someone who calls themselves an expert who says that everything is doomed and that everything is bad and that the US is going to bankrupt and that is going to erase all your money and that a recession is coming. I've heard that. Yeah, we've heard that quite a lot over the past 2 years. Like a recession was coming for 2.5 years constantly and none ever came. So, there's always someone who wants to get clicks by spreading negativity. Um, Although many of these news can be true, it's generally not good to sell off your investments based on that. That is not to say that some negative news won't lead to market declines. As I said many times in this presentation, market declines are normal and they happen all the time. This was just to illustrate then that in most cases, the markets will not react by a significant decline and will grow despite there being negative news. What you can, if you overreact and sell off your investment, you can miss some very good days, and that can be bad. Here in this chart, you can see an investment of 10,000 again into the U.S. stock market as a whole, right? So many companies, 500 of them, over 20 years, over a 20-year period. So from 2002 until 2022. If you just stayed invested and forgot about it for 20 years and then you remembered in 20 years that, oh, I have some money here and then took it out, you would have 64,000. The lines below that just show missing a couple of best days. Imagine how many days in total there are in a 20-year period. If you just miss the 10 best ones because you panicked in front of them and then, sold off your investment and decided to come back in a couple of weeks when bad times are over, if you miss just 10 best days, you gain less than your result is less than a half of what you could have earned, right? And it gets worse and worse. So usually the highest profits are concentrated into very short periods, into a couple of superstar days, right? If you miss out on them, and there is a good chance that you miss out on them because you just try to react to news and speculate, you will lose a lot of money. So the best thing is to stay invested to maximize your chance that you will be there when the superstar days come. And we have data to suggest that, most people don't do this, that most people don't just stay invested. There is a study called Dalbar. It's a company that also produces a study with the same name, right? Or I think the name is slightly different, but that doesn't matter. This Dalbar company has access to client brokerage accounts. They can see how regular investors like you and me invest when they try to buy and sell stocks on their own, right? And they can compare that with just returns of indexes, right? As I said, there are indexes such as the S&P 500, which just track how the market has behaved, and that is an equivalent of an investment when you buy that index and just do nothing for 20 years and then you sell it, right? You can see that the average investor is earning significantly less than the market themselves, right? And that shows year after year in that study. You probably know this by pictures that you know off the top of your head. For example, have some of you tried opening, brokerage accounts or eToro or XTB? There is always this small disclaimer in small letters that says that most of the investment accounts of common people are at a loss, actually. So that's not just not making enough money and beating inflation or making less than the market. That's literally losing money on their speculations and on trying to invest. And this is that is a confirmation of the same trend, right? When you try to predict how the market will behave, you will never succeed because you are going up against people who have much more information, who are, more equipped, who have more people, who have their analysts, right? And it's very difficult to uncover something that they don't know already, right? So it's better to just, buy it and base your investment on benefiting or profiting from a generation of advancement. And that is what is called in the world of investing passive investing. I promised to explain a difference between two investment approaches. One of them is called active investing. So one of them is called active investing. The other is called passive investing. So active investing is what I described by sort of speculating, right? When you are an active investor, you try to be smarter than the market as a whole, right? So you try to select a couple of companies, not the entire market, not hundreds, but perhaps a couple of tens or maybe 100, which you think have the highest prospects of earning a lot of money and being, the game changers over the long run, right? So you try to select the next Bitcoin, the next Nvidia, the next Tesla, right? The big stories. You try to identify which ones those will be. And you also don't just hold over long periods, but you try to predict when the market will grow and when it will decline, so that when it will decline, you can sell off and come back after bad times are over. And so that when it grows, you are there fully. Maybe you even borrow money to invest when it's growing, right? In contrast, passive investing is just buy and hold, right? You buy the entire market. You don't speculate which companies will be the most successful. You will buy them regardless of which one will be successful and which ones won't be. And you hold it for a very long period without caring whether it will decline or grow in the meantime. And you sort of accept that it will decline many times over that period, right? Studies. The most popular one is called Spiva. It's produced by S&P Global. And they just compare mutual funds, so actively managed investments, because mutual funds usually have their portfolio managers and analysts who try to predict which companies will be successful and who try to predict whether the market will go up or down. So these are professionals. These are people who have certifications, who have universities, and who have teams of very smart people. So this is professionals against the market, and they just contrast it to market, right? So S&P 500 and how much it made with all its declines and growths and with all its large groups of companies, among which are both successful and unsuccessful ones. These data, these comparisons, show that over longer periods of time, let's say 10 years or 15 years, a giant majority of actively managed investments, even from professionals, fail to match the performance of the market. This is because of many logical reasons: emotions, fear, and greed, right? Not based on rational calculations, but based on the fact that we have the fear of missing out, or we are afraid that we will lose the money to which we have emotional connection, right? Or that we'll lose our career. So emotions, imperfect information. Even if you are a mutual fund manager in Slovakia, the guys, in hedge funds still have better information than you probably. But also inability to predict the future based on the past and based on what we know now, right? It's just, if the future could be predicted, everyone would be doing it, right? It's usually just impossible which companies will be successful, because it doesn't depend on rational factors. It often depends on completely unpredictable human behavior, right? Sometimes there are two equally good products, but one company just manages to become trendy and become more sexy, let's say. And it can be completely irrational. It can even be stupid, right? But that means that you cannot predict it based on what we know today, right? So often the best way to hold the winners is to hold all the companies, because there will be winners among them, right? And there will be a very few of them. So when you try to select, let's say, 30 companies from 400, you are much more likely to pick losers than winners, because there are not many winners, right? And that is what illustrates why the passive approach usually works better, even among professionals, and among common people even more so, because common people often end up in losses when they try to invest, right? I see the questions. By the way, David, I see both the questions in Slido. I will answer the interest rate question, which is a great question, or a great remark. I will answer that at the end. Now, I really love the question of why is everyone talking about investing on American markets? Is it possible to trade elsewhere like China, Russia? It is. And I have a slide on that in, I think, 3 slides. And I know that even I presented a lot of American market data here. That is because they are the most available in general. We usually don't have 200 or 100 years of data elsewhere, but I will show you very good reasons why you shouldn't only invest in American markets. And I don't think that you should only limit yourselves to that country. And I will show you a very beautiful chart for that. So give me 3 slides and you'll see. Okay, so this is the passive investing. Passive investing is usually done by buying investments or investment tools that track so-called indices. Index is a sample of the market. Let's say you have thousands of companies in the market and you select a large portion of them that are representative enough that they sort of represent how the market performs, right? So indices can be for anything, right? They usually are limited to some region, right? You can have indices of large American companies. You can have indices of small American companies, but also, I talked about S&P 500. In Europe, we have Stocks 600. That's 600 largest stocks of companies headquartered in Europe, right? Both in continental and in the UK. You can have an index of emerging markets. That is China, India, Russia, and Brazil and similar countries, right? One of the most popular ones is called MSCI EM. So MSCI EM as emerging markets. MSCI is the company that constructs it, right? You can have indices focused on large companies and on smaller companies. And it's good to select, enough indices so that you cover the whole world. And now, that is the slide I promised. Okay, so it wasn't even 3 slides. It was just 2. Why you should invest in the entire world, right? So I spend a lot of time presenting American data because they are available, but that doesn't mean that you should limit yourselves to American data. And that is, let me tell you another story, right? I think stories are good, and it's again a story that my boss here taught me, right? So today we live a world where there is a huge trend of investing in the US stocks because for the past couple of years, they just have been dominating the world because they happen to have an amazing environment for technological companies that are the biggest and, successful. So, Nvidia, Apple, Tesla, those were the companies that you sort of saw breaking the records in the last couple of years in the media, right? What usually happens in the world of investing, and remember, we are investing for 25 or 20 years. We shouldn't be doing that for a couple of years. Is that whenever that sort of couple of years domination happens in some type or geographical regions, everyone just wants to invest there and God forbids you invest elsewhere, right? The problem is that different time periods tend to be dominated by different stocks. And this is best illustrated by a story, that my boss told me. That is, what these trends looked like when he started to invest. So he came into the market shortly or around the great financial crisis of 2007, 2008. I think it was shortly before, roughly 2006, right? During this time, there has been a so-called lost decade in the US stocks. That meant that over more than 10 years, slightly even, S&P 500 has made nothing. That is because in early 2001, it started in 2000 already, the dot-com bubble burst. This was a wave of emotional investing into early, very young internet companies, many of them not having any profits. Then everyone realized that it was just, a trend, a bubble, a market value that wasn't really justified, and markets plummeted and kept falling for a couple of years. Then it took them until 2008 to recover when the great financial crisis happened. And again, that crisis again originated from the United States. So the US indices have been most hardly hit by this crisis. So they fell again. 2 very significant crises in a row, and which meant that, as you can see in this beautiful picture, between 2001 and early 2011, you made zero by investing in the S&P 500, nothing. In the same time, emerging market stocks, especially concentrated in a group called BRICS, so that included Brazil, Russia, India, and China. Very, very high, very large countries, right? Emerging markets rose by 437%. That means that an investment into them, while you would have nothing in the US stocks, your investment would have grown to more than 5 times its original value by investing in the emerging markets, right? So there was not much growth elsewhere, and most of the growth in these four countries or in emerging markets. That means everyone was only investing in emerging markets. Back when he started, 2006, 2007, mutual funds focused on BRICS were selling most money. Everyone was trying to analyze those countries and only invest there, right? ETFs were being created for those countries, and everyone was sort of forgetting about the US, right? Because it made nothing, right? And everyone thought that, look, the financial crisis began there. They are a fragile country that shouldn't be trusted, and so on, right? You know what this chart would look like in the next 10 years after this. So when everyone thought that BRICS is the future, and it was like, it was very easy to justify it. US is now a mature country, not much room to grow. India, China, they have a lot of uneducated people. They have amazing demography. They have a lot of talented young individuals. They have great universities and parents willing to pay for education and everything. It was very easy to justify that the next decade or next 30 years would be ruled by BRICS. You know what happened in the 10-year period from 2011 until 2021? US has been the dominating country. This graph completely reversed. And emerging markets made some money, but not much. It was, I think, 4 to 5% per year, right? So this beautifully shows that oftentimes regions that have been forgotten tend to grow the most or can, not tend. That would then be easy to win with active investing. But oftentimes regions that everyone is underestimating can end up to be the winners in the future. And those which have been superstars for the past couple of years can disappoint expectations. And it's easy to justify because for superstar regions, expectations are high and everyone expects them to grow and they are expensive. For those who have already been forgotten, expectations are very low and it's easy to exceed them then and generate growth because they are exceeding expectations, right? So just the fact that the US has been dominating and emerging markets are being forgotten now because they had a difficult decade doesn't mean the trends won't reverse. So different periods are dominated by different regions. And the only way to hold the winning regions in all times is to invest in the entire world, right? So not just have the US, but have US large and US small companies, have European large and European small companies, have emerging markets, large companies, and emerging market small companies, right? That is how you don't let these trends influence you. The last idea I would like to say is related to our favorite investment tool. So as we said, we think that passive investing is the best style of investing for common people and for everyone really who wants to build their wealth, right? The best way to invest passively is via ETFs. ETFs are tools. They are called exchange-traded funds. They work very similarly as mutual funds. That means if you buy them, they include hundreds, sometimes even thousands of companies. So you can buy a lot of companies with just one purchase via these tools. And they are traded on a stock exchange just like any other stocks, right? However, what is also there another feature is that ETFs were created for passive investing. That is, they usually just reflect indices. So when you buy an ETF, it doesn't have a portfolio manager computing their numbers and trying to buy the winning stocks. The manager of the ETF looks at stocks 600 or S&P 500 and checks what companies are in there and buys all of them and just holds them. And the only time they change the companies in the index is when the index itself changes composition, right? But they just reflect the value of indices pretty fairly. They just have a very low internal fee for management and everything. So advantages are higher returns for all the reasons that I described because they are passive. They are also liquid. That means you can buy and sell them fairly quickly for a very fair price. That's compared to, let's say, investment properties, because if you want to sell real estate, it will take a lot of time, a lot of nerves, a lot of transaction costs. This can be done with a click. They have diversified risk because they contain hundreds or thousands of companies. If something happens to a small portion of them, if one company goes bankrupt, you will probably not even see it in the value because it's such a small portion of the portfolio, right? So they are also diversified, which shields you from risk of anything happening to a single company or a small number of companies. because they don't have sophisticated portfolio managers and analysts and someone who tries to predict what will happen in the future. They don't have to pay their salaries and their access to that databases and their supercomputers, which means they can charge very low fees. That is, you can minimize the costs, right? And this is specific for our countries, or for the countries where, for the country where I live. But for example, it also applies for Czech or for Croatian residents. They often carry tax advantages, right? This is because experts often recognize that they are a very good investment tool, so they try to advise governments to shield them from taxes, right? So in Slovakia, after a yield of holding ETFs, you don't have to pay any tax on profits, which is a significant amount of money. In Czechia, it's after 3 years, and in Croatia, it's after 2 years of holding. You just have to invest for the long term, which is, you should always do, as I explained, but then you can shield yourself from taxes by choosing ETFs as your instrument. Where can this get you? This is a table that I already showed you last time. Last time I showed you that it's important to also be able to save a lot, because it's often much more valuable to your money than speculating and earning a higher return. But this is the value of your portfolio to which you can get after investing for 30 years. If in 1 year you invest just the amount above. So when you take that, that's not a lot of money to accumulate in savings over a whole year, over 12 months, when you have 12 salaries to sort of accumulate that, right? So if you manage to save, let's say, 10% of your yearly income, and you manage to earn market returns, which, as I showed you, are often around 8% in the long run, you can get to very significant amounts of money. You can see that it's 150, 170,000 euros. That is a lot. And in many times, markets are even growing by slightly more, because those 7 to 8% that you saw in the charts were already net of inflation, right? So before inflation, it's often 10 or 12%, which is, in nominal value, you have to subtract inflation, but it's around 200,000 euros. So the thing I wanted to explain here is that you don't have to be a millionaire, or you don't have to be a Harvard graduate to achieve this result, right? For university-educated people, it's often possible to save 10% of their income, and it's possible by just buying ETFs and holding them for a generation to earn returns nearing 8, 10, or 12% per year, right? That can lead you to results that are sort of counterintuitive by how large the numbers are, right? Being able on a regular, salary of university-educated people, being able to build up 246,000 euros, for many people, it sounds unimaginable. But that's how the math of compound interest and of really being really, really patient looks like and accumulates to. So that sort of is to motivate you at the end that this amount of money would be a great support for anyone in their 50s or in their early 60s, right? So it's a great goal to strive to. To conclude, today we have discussed why, or not today, there was a last time, but people often limit themselves to bonds or cash because they are afraid of losses. But they forget that by holding cash with interest below inflation, or bond funds that often don't manage to match even the 2% or 2.5% of inflation per year, means that you have a certain loss, because inflation erodes the value of your money. So just because there is a possibility of loss doesn't mean you should exchange it for a certain loss, right? That's logical. Stocks have higher risk and return, bonds vice versa. So you can use bonds to mitigate risks when you invest for shorter periods or where you are afraid of risk. ETFs can be used to buy the whole market at a low price, which is the basis of what you need to do if you want to buy the market. And if you can't beat the market, which even most professionals can't do, make it your friend and benefit from the rise of its profitability. And sort of at the end, there are two ways you can buy ETFs, either directly through a broker like eToro or XTB. There you will save on costs because they are usually the cheapest option. But you can also invest through robo-advisors such as Finax or Porto or similar companies that are in the market, which will be slightly more expensive, but they will relieve you of any technical or time burdens, such as having to decide the split between bonds and stocks yourself, such as having to split the deposit among the ETFs that you want to buy, or such as just time needed to manage the investment if you, for example, want to rebalance it because the weights have drifted too far away. If you want more on this comparison, you can watch our webinars or podcasts. We explain this difference a lot there. So that's all for the content I prepared, and I will be happy to answer questions now. Thank you very much for listening and checking the slides. And now I see some questions in the chat, very interesting ones. So let's delve into them so that we covered that as well. So the first question that came throughout the presentation was in regards to 3% interest rate. Airbank now offers 3.4% interest rate paid monthly for up to 1 million Czech crowns saved on normal accounts. That's great. That's great. As I said, it's usually I didn't want to say that there are no solutions that offer amazing interest rates. I remember also Revolut having a pretty interesting savings account. In Slovakia, we also had a couple of banks. I think, for example, FIO or similar banks have been offering very competitive rates. What you can notice that it's often either online banks or smaller competitors. Usually the largest banks face the lowest pressures from their clients because they are just giant and everyone is with them just because they know them. So those usually have offered the least competitive savings accounts. For example, in Slovakia, the average of interest rates on deposits on current and savings accounts is 0.07%. So that goes to prove that point. But this is exactly what I wanted to say. You have high interest savings accounts, you have money market funds, you have ETF products such as Smart Deposit from Finax, which manage to reflect the deposit rate of the European Central Bank pretty accurately. 3.4%, that's amazing. That's almost the deposit rate of the European Central Bank. So all I wanted to say is don't be satisfied with zero and try to look for these solutions. And you are guaranteed to find either an online or an innovative bank that offers a high interest savings account or a money market fund that pays out a stable return or a robo-advisory solution based on ETFs that also pays out a stable return and allows you to withdraw at any moment, right? So that is all I wanted to say, is that just because the larger banks may not be offering, it's really worth it to look around for these options and get this interest because 3.4 is a lot, right? So that is exactly the point. And thank you for suggesting a solution for savings in Czech koruna. That is amazing. Hi, Simon. Do you see any risks that government, especially after what happened in Slovakia in recent days, will consider deducting tax from profit on the ETFs? We get this question asked a lot. We'll see, to be fair. We'll see. Because on one hand, so far there haven't even been, any suggestions to do this. It's possible, of course, just like there are risks to second pillar savings and everything. It is possible, although we don't see much pressure yet. It's always possible. There are two things to know about this. Number one, tax changes or tax code changes cannot be applied retroactively in Slovakia. I think that's even in the constitution. So no tax change ever has been applied retroactively, and it's impossible. If you have investments now, or if you invest before any change happens, your investment or the pieces of ETFs that you bought before that change will still remain tax exempt, right? So it's only a reason to invest as much as possible before anything like that happens, right? But of course, it is possible. We don't see that happening in the next 2 or 3 years, but things can change. I think you will see it in the media, but rest assured that it cannot be applied retroactively to investments entered before the change, right? The second point, because what happened in Slovakia in recent days is that the VAT rate increased. So the last tax that was relatively low in Slovakia is gone now, and they have also introduced a financial transaction tax for companies. Things like that. But it's still, we believe that there will be ways to mitigate the impact, especially on clients of this, especially since, a 3% raise in VAT, for example, is not such a big raise in fees of your investment. So there should be a limited impact there yet. But the main point is about the retroactivity. But text code can always be changed, but not retroactively. So yes, let's move on to another one. How to change my current Finax investment strategy. This is specifically about our products, but I'm happy to advise. Either when you can log in through the website or log in through the app, and there is this section called advisory, or in Slovak poradenstvo, or and anything similar to advisory in other languages. And there you will see a button leading you to change your investment strategy or change your investment questionnaire, something like that. You will have to refill the questionnaire with your new situation. So, for example, your investment experience might have changed, or your attitude toward risk, or you discovered that you can keep the money for longer and you won't really need it in 3 years, but you can keep it for 10. So you can change all these parameters and it will suggest a new strategy. And if it looks good, you can click change, and within a week, it will change. So through the advisory section, and there should be a button for changing of strategy, refill the questionnaire. When choosing ETF, should I stick with big players like Vanguard or BlackRock, or it does not matter as long as the ETF really copies the index correctly? It shouldn't matter what much. When choosing our ETFs, for example, we also try to stick with the largest players. That is for the simple reason that usually the largest players are the ones that can offer it at the best cost, right? Because they are large, so they can afford to push down the low fees even lower, right? Smaller companies often don't enjoy these benefits of scale. So the largest players are often the ones that can replicate the index the most correctly, right? Or the most closely, because they have the lowest management costs and so on. But if there is a cheaper ETF or something like that, and also, one more advantage is that if you have these ETFs which are large, right, have huge assets under management, usually those from BlackRock, Vanguard, Amundi, or similar players, a lot of people buy and sell them, which means that it's easy to, they are sort of liquid. This is a technical term. I know it might be relatively difficult to understand, but if there are not many buyers and sellers of a specified security or an ETF, there will be larger so-called bid-ask spreads. That is a type of transaction cost, really. You can Google it if you want the details. But the main thing is that if the bid-ask spread is wider, that means higher costs of buying and selling that ETF, right? Which especially for us as Finax, right, who trade in large volumes, can be bad, and it's some extra cost even for you as an investor if you want to, for example, sell a regular investment, right, every month. So we will incur the transaction costs once a month, right? So having the larger ETFs with large volumes under management can sort of mitigate these transaction costs. So that is the rational reason why usually sticking with big players is good. But if you find a smaller provider which has a significantly lower total expense ratio, which is the cost that usually determines the difference between the index and the ETF, and they have a reasonably large ETF, and you can see that their tracking difference has been low since they've been launched, I wouldn't be afraid to support them. For example, we are now launching portfolios in Poland, where there is a new company, the first company creating ETFs denominated in Polish zloty that will track Polish markets, and we are cooperating with them to sort of create more localized portfolios. Yes, they are more expensive because they are a smaller player and because the Warsaw Stock Exchange is not the most developed market in the world. But supporting these players means they can grow and offer better services in the future, right? So if they have reasonable costs and you can see that the difference between the index and the ETF is not very high, then cool. You don't have to be afraid much about bankruptcies and similar things, because these client wealth is usually stored in a separate custodian, and your investments are often, especially in Slovakia, they are protected by an investment guarantee fund, which has insurance up to 50,000 euros for your investments, and also client wealth usually has to be stored separately. So even if some player bankrupts, usually they just get acquired by a larger player just like it happened with the banks that went bankrupt in the US in the last March. All of them essentially got swallowed by JP Morgan or similar players, and their clients didn't lose any money, right? Because wealth is separate. But yeah, they are also safer from these bankruptcies, which can cause problems, hypothetically. So yeah, I usually they are the best option, but not necessarily. Okay, thank you very much for your questions. Is there anything else you would like to know? Thanks for your questions, David. And thank you everyone for paying attention and being here. Okay, if there are no other questions, if you want, feel free to think about your questions either for our webinar next week or message me on my LinkedIn, message me on my email. It was at the title slide that you will get PDFs of these slides as well as the recording soon. So feel free to email me or message me or email the entire Finax at client@finax.eu or any other means. Me and my colleagues are happy to answer questions even there. And if it's good, we might even include them in our podcasts where people often ask questions. With that in mind, thank you for being with me here. I hope you learned something valuable and enjoy your day, enjoy your weekend, and see you next week with the last topic of retirement planning. Thank you.
Thank you very much. See you.
Thank you. Bye-bye.